In 2021, Callaway thought it had finally found the future of golf. The company had just paid $2.6 billion in stock for a chain of driving ranges with neon lights and a kitchen. Wall Street called it the smartest deal in the history of golf equipment. Inside the first year, the stock climbed to $33 a share. The combined company crossed $3 billion in annual revenue for the first time. 5 years later, Callaway sold the same chain of driving ranges for $660 million in cash. They sold 60% of the business they had once called transformational. They sold it to a private equity firm in Los Angeles. They sold it for roughly a quarter of what they had paid to buy it. This is the story of how a microchip in a golf ball became the most expensive merger in the history of the sport. Topgolf was not invented in America. It was invented in 1997 in Watford, England, by twin brothers named Steve and Dave Jolliffe. They had sold a mystery shopping business and were bored at the local driving range. They wanted to know exactly how far each ball traveled and exactly where it landed. So they did something nobody had tried. They put a microchip inside the golf ball. The first venue opened in 2000 in Watford, just outside London. The original name was Target-Oriented Practice Golf. The British golf establishment refused to take it seriously. The Professional Golfers Association refused to endorse it. The Jolliffes built it anyway. In 2005, a businessman named Richard Grogan bought the American license. He opened the first United States venue in Alexandria, Virginia. The Dallas venue, opened in 2007, had a 6-hour wait by the end of its first summer. That was the inflection point. Dallas unlocked everything. By 2015, the company had 28 venues across the United States and 8 million annual customers. A private equity ecosystem formed around it. Providence Equity Partners, West River Group, Dundon Capital, the family office of billionaire Tom Dundon, who also owned the Carolina Hurricanes. By 2020, Topgolf was privately valued at $4 billion, with 80 venues and over $1 billion in annual revenue. That was when Callaway entered the picture. Callaway Golf was a 40-year-old equipment company headquartered in Carlsbad, California. Drivers, irons, golf balls, apparel. The chief executive was Chip Brewer, who had run Callaway since 2012. Callaway already owned 14% of Topgolf from earlier investments. In October 2020, Brewer announced he would buy the rest. The deal closed in March of 2021. $2.6 billion paid entirely in Callaway stock. Existing Topgolf shareholders, including the Dundon family office, became the largest holders of the new combined company. The press release called the merger transformational. The annual report called it transformational. The investor day called it transformational. Wall Street believed it. Callaway shares climbed to $33 in the first year after the merger. The company was renamed Topgolf Callaway Brands. The stock ticker was changed from ELY to MODG. Combined annual revenue passed $3 billion by 2022. But beneath the new logo, the math had started to come apart. A Topgolf venue cost between $30 million and $70 million to build. Each venue was financed through a complex sale and leaseback structure with real estate investors. Each one carried a long-term lease obligation that did not appear as standard debt. By 2024, the combined company carried over $1 billion in term debt on the corporate side, and Topgolf alone had taken on roughly $2 billion in additional obligations through those leases. Same venue sales had gone negative. The post-pandemic surge had ended. New venue construction continued to add revenue, but customers were visiting existing venues less often. The unit economics of a Topgolf venue depend on traffic. The traffic was falling. In September of 2024, Chip Brewer announced what no chief executive announces unless the original thesis has failed. He announced the company would separate Topgolf from Callaway. The press release used the phrase, "maximize shareholder value." In plain language, it meant the merger had not worked. The market reaction was immediate. Callaway shares fell roughly 15% in 2 trading days. Brewer told the earnings call the spinoff would close in the second half of 2025. It did not close in 2025. In July of 2025, the Topgolf chief executive, a man named Artie Starrs, resigned. Brewer announced the spinoff would be pushed to 2026. By that point, the term debt was a serious problem. The convertible notes were maturing. The leases were locked in. The buyer pool for an entire public spinoff was thin. Brewer changed the strategy. He started looking for a private equity buyer instead. He found Leonard Green and Partners. Leonard Green is a private equity firm based in Los Angeles. They had been buying distressed consumer assets for 2 decades. On November 17, 2025, Callaway signed an equity purchase agreement with a Leonard Green vehicle called LG-PTG Aggregator. They agreed to sell 60% of Topgolf and Toptracer for $660 million in cash. The deal closed on January 1, 2026. The 8K filing was made public 6 days later. Callaway used the proceeds to pay down $1 billion of term debt. By February of 2026, the company had returned to a net cash position for the first time in 5 years, with approximately $680 million in cash and approximately $480 million in remaining debt. Callaway renamed itself again, Topgolf. Callaway Brands became Callaway Golf Company. The stock ticker changed from MODG to CALY. The annual report described the company as a pure play golf equipment company. 5 years and 10 months after the merger was called transformational, the company that had bought Topgolf was no longer named after it. Next on paper trail, Beyond Meat, the plant-based protein company that went from a record-breaking initial public offering to a debt-to-equity swap that issued 316 million new shares to bondholders. The shareholders were diluted to near zero. The 8K is public. Here is what the paper trail names. Chip Brewer is still the chief executive of Callaway Golf Company. His total compensation for 2024 was approximately $7.8 million. The Form 4 filings are on file with the Securities and Exchange Commission. Artie Starrs, the Topgolf chief executive who resigned in July of 2025, received a separation package filed in the second quarter, Form 10Q. Starrs left before the sale. Brewer remained to sign the sale documents. Leonard Green and Partners holds 3 of the 6 manager seats on the new Topgolf Operating Board. Callaway holds 2. Callaway loses its right to designate any managers if its remaining equity stake falls below 20%. The original Topgolf shareholders from the 2021 merger, the Dundon family office and the Providence equity holders, received Callaway stock at an effective price of approximately $32 a share. As of February of 2026, the Callaway stock was trading at approximately $8.50. The Dundon family office is reported to have lost approximately $1 billion on paper through the cycle. The merger was the LIE, not the founding, not the business, the premise. The premise was that a golf equipment company and a hospitality venue chain belonged inside the same parent. The premise was that scale across both halves would compound. The premise lasted 4 years. The buyer of the second half is a private equity firm whose own model depends on extracting the venues from the assumption that built them. If you want the next filing explained before the next collapse, subscribe. Every paper trail is already open. We just follow it. Here is where we are today. Callaway Golf Company sells drivers and irons and golf balls and apparel. It owns 40% of a Topgolf business that is now controlled by Leonard Green and Partners. The 80 Topgolf venues continue to operate. The Top Tracer technology continues to be licensed to driving ranges around the world. Chip Brewer continues to run Callaway. The $200 million share repurchase program announced in January continues to buy back shares from the same shareholders who watched the stock fall from $33 to single digits. The Jolliffe twins, who put a microchip in a golf ball in 1997, have not been associated with Topgolf for 2 decades. The original idea was that a driving range could be entertainment. That idea still works. 8 million people a year still walk into a Topgolf venue. What did not work was the idea that putting 8 million people a year inside a public golf equipment company would make the equipment company worth more. The $2.6 billion merger was unwound for $660 million in cash. The transformational acquisition was reversed at a 75% discount. The future of golf turned out to be the same business the Jolliffes were running out of a single venue in Watford in 2000, a driving range with a microchip in the ball. The customers found out which one was true on the day the company changed its name back.